Traders, on the second video of the free Forex course, we're going to be talking about indicators. And the first question is, do the big players use indicators? Are they looking at indicators like moving averages, RSI, and so on and so forth? And the answer is yes. This is a screenshot from a Bloomberg terminal. In order to use a Bloomberg terminal, you have to pay $25,000 a year on at least a 2-year contract, basically $50,000 in 2 years. And guess what? You can see here this an analysis by a professional analyst, and he has moving averages here. And we have the RSI over here. Do you think they could be paying $25,000 a year to use this platform, and the platform had indicators if they didn't use them? Now, I'm not going to tell you professional traders in big institutions are looking at indicators in a 1-minute chart or 2-minute chart. They don't look at 1-minute charts or 2-minute chart, guys. This is a daily chart, of course, okay? And although they do look at smaller time frames, they're not trading or looking at 1-minute, 2-minute charts. If we want to do scalping on those charts, that's fine. But let's stop over analyzing what supposedly the smart money is doing on a 1-minute or 2-minute chart, guys. They're not looking at the charts. Anyway, this is another screenshot of another Bloomberg platform, and here we have what the professional traders call a dead cross. It's when the 50 moving average is crossing the 200 moving average. Okay, it's a possible big change in trend. Now, again, this is on a daily chart, weekly chart, not on a 5-minute chart. And we can see they are using a simple moving average, 200, 50, and a 10. That's what they are using. I usually use a 20, and I will explain why. But as you can see, this trader, professional analyst, this is what he's using. He's alerting the market that we have a dead cross. Now, they're not taking trades just based on that, but it's information that the market is telling you. Now, why moving averages are so popular these days? To check information about the trend? Well, it is because computers are drawing those indicators automatically, and you don't have to do it. Back in the day, traders weren't using MAs. Why? Because they weren't going to be doing a lot of mathematical calculations to draw. They used just trend lines. Now, I'm going to show you how to draw a trend line, the correct way to draw a trend line. Because I see a lot of information out there, or traders analyzing the market, and they are forcing the price to fit in the trend line because they don't know how to draw it, and it's not giving you good information. They are drawing trend lines like this. In fact, I'm going to show you some examples. This is a very good example of how not to draw a trend line. And I had to hide the logo to protect the innocent. But look how they are drawing, okay? This trend line. They are forcing the price to fall into the line. What information is it giving you? Nothing. It's completely wrong, and it doesn't give you any valuable information. Now, some traders will tell you, oh, I look at the market a different way. No, man, there is only one market, and there is only one side where you can make money, the right side of the market. So the problem is that with social media, we have all kinds of people teaching, uploading videos, this, that, and the other. 90% of them, as far as I can tell, don't know what they're doing, don't know what they're telling, and they couldn't make money trading to save their lives. So you have to be careful where you get your information from, because you're going to be risking money using that information, okay? And there are only a few, extremely few people online that are teaching and uploading videos that know what they're talking about. So you have to be extremely selective. This is another example. They are forcing, okay, the trend line to hit as many spots as possible. That's why they drew it that way. What kind of information is this? Giving you absolutely nothing. It's absolutely irrelevant, the information it gives you, because it is done the wrong way. I want to teach you the right way, going back to the source, the traders, professional traders of the past, and the rules they had, and how they use these trend lines. Okay, like I was telling you, this is a chart that was drawn by professional traders probably 80 years ago to know information about the trend. So the rule is this: in the first impulse, which is this one, you have to connect, if it's a downward trend line, the two first points of the first impulse and then extend the line. And as the price keeps moving, it's gonna tell you if the move is accelerating, or it's keeping the same pace, or it's breaking that the downward trend in this example. And this is exactly what happened here. So now what do? They take the first 2 points of the first upward impulse, they draw it here, and they extend the line. They didn't have computers, so they were not going to use MAs, moving averages. In fact, they used to hire people to draw these charts by hand on huge pieces of paper. I talked to a guy, an old man, who used to do this job for a hedge fund. They called it, they used to call themselves syndicates back then. Okay? And then when the trend is accelerating, they were drawing a new trend line. I mean, yeah, a new trend line. And if it kept accelerating, a new one, knowing that the price was accelerating. So it gives you valuable information about the trend that is accelerating. Of course, you can see it without drawing the trend line, but this is helpful to see exactly where it becomes accelerated. So in other words, trend lines as well as moving average, and we're going to look at them, give information about the trend, how accelerated it is, if the acceleration is healthy, or if it's way too accelerated, more than a 45-degree angle, it won't be sustainable. That's the information it's giving you, and that's how professional traders used to use it. Now let's look at some charts. And let's see if big professional traders are looking at them or not. This is the bear market of 2022, okay? And we're gonna use both moving averages and trend lines. And let me remove the extension. Okay, here it is. This is the first impulse of the downward move on a weekly chart. Okay, guys? So that's exactly what I did. How the ones who invented this methodology used it. The two first points of the first impulse, downward impulse, and then just extended to the right. And as you can see, it came back and it hit right there, and it kept going lower. And then it came back, penetrated the trend line, big selling started coming in, and then it went back below the trend line. Finally, it broke the trend line decisively, and then look what happened, guys. It came back. Now the trend line became support, and we have a huge amount of volume. Remember what happened here in March 2023? Regional banks were going bankrupt. Big panic in the market caused this downward move. All the news were negative. All of a sudden, we spotted in the chart big institutional buying through looking at the volume. This is the biggest volume so far in 2023 in a weekly chart. Look at this. 2022, This is September, where we're making the video. 9 months. This is the biggest volume by far. We knew institutions were buying here, or were very certain institutions were buying. So despite of the bad news, we decided to enter the market. Our stop was over here. Now, we didn't know what was going on. Eventually, everybody figured it out. The regional banks were going to be rescued. They were provided with a lot of liquidity, $300 billion. Now, some say that the big banks, the big institutions, are smarter than the rest of us. That's why they are called the self-proclaimed smart money. Others say that they have connections of ex-workers working for the government, and somehow they get the information. But regardless, what is the truth? They position themselves long here. You can see by the volume, because only the institutions have the power to buy billions of dollars or millions of dollars in an hour or two. So we decided to buy them, and we entered with options, but it's the same thing as if you buy a future contract or an ETF or a CFD contract, whatever. And we took advantage of this move. We closed the position with 141 profit. This is an option, so the whole price of the option is my risk for a couple of $1,000. We showed this on several presentations when the trade was, when we just took the trade and we were analyzing the trade in my YouTube channel, but that was in Spanish. But anyway, let's go back. As you can see in this weekly chart, what reference did the big institutions, did the smart money, commercial banks used to buy the S&P 500? The 200 moving average, guys. Here it is, okay? 200 moving average. They penetrated the 200 moving average, and that's where they bought. That was the bottom of the market, 200 moving average. So they are looking at those guys. So 200, and let's look at Microsoft. Where did Microsoft stop? The downward move, 200 moving average, guys, of the bear market of 2022. Okay? So, yeah, they are useful to give you information about the trend. Look, for example, Microsoft right here. It is overextended. How do I know? The price is way too far from the 20 moving average. This is a stock. The stock market is open 20 days a month. So the 20 moving average give you the average price for a month. Okay, that's why it's very popular. And as you can see, the price tends to go back to the median, which is the 20 moving average. Now, when it's overextended, if I'm just trading, it is time for me to take some profits. Look how there was a heavy selling right here. Okay? And it came back well to the 20 moving average. I don't use them to take trades, as you can see. I'm just analyzing what's going on around them. If the institutions are looking at them, just like here when they bought Microsoft, just after it hit the 200 moving average. Now, they didn't buy it just because it hit the 200 moving average. The whole market, as a matter of fact, all markets, including the Forex market, gold market, turned around in October. And there are other reasons for it that I can discuss in another video if you want. But bottom line is, they do use them as a reference. Okay, in October, that's where everything turned around. So these are used to give information about the trend, how accelerated it is. Like in this case, if the acceleration is healthy, like in this one move, it was pretty healthy. And the RSI gives you information about when the trend is getting weaker, like here, for example. You have what is called a divergence, and it's telling you not that the market is gonna turn around. It is just giving you information that it's losing momentum. That's it. Okay. And when we are in conditions of overbought or oversold, it is telling you it is completely overbought. And that's about it, guys.